Last month, a crypto analyst discovered a project trading at 8 cents. He ran it through his research framework, checked every box, and invested $5,000. Today, that project is worth $340,000. That's a 68x return in under a year, and it wasn't luck. It was systematic research. While everyone else was chasing meme coins and following influencer calls, he was using a proven framework that separates real 100x opportunities from garbage. And today I'm giving you that exact framework. Welcome back to the channel, and if you're new here, hit that subscribe button right now because we're on day 4 of our crypto series, and today we're answering the most important question in crypto. How do you actually spot a 100x project before everyone else sees it? Not guess, not gamble, not pray, but systematically identify high potential projects using the same research frameworks that venture capitalists, early stage investors, and professional analysts use. By the end of this episode, you'll have a practical, repeatable checklist you can use for every single token you consider. This is the difference between hoping for returns and engineering them. Let's get into it. Let's start with complete honesty. 100x tokens are absolutely real. Ethereum did it, going from 30 cents at ICO to over $4,800 at peak. Solana went from under $1 to $260. BNB went from 10 cents to over $690. Polygon, Avalanche, Chainlink all delivered 100 times plus returns from their early days. But here's what most people miss. They all shared one thing in common. Their fundamentals were obvious long before their price exploded. Ethereum solved the smart contract problem when no one else had. BNB solved exchange utility and became the backbone of the largest crypto exchange. Solana solved high-performance blockchain scaling with proof of history. Polygon solved Ethereum's congestion and high fees with Layer 2 technology. None of them came out of nowhere. They didn't pump because of hype or influencer shilling. They pumped because they were building real solutions to real problems, and smart investors identified this early. The market eventually catches up to fundamentals, always. Your job is to identify the fundamentals before the market does. That's how you get 100 times returns. Today, we're breaking down the exact 7-layer framework that early investors use to find these projects before the crowd arrives. This is the same framework used by firms managing billions in crypto assets, and you're about to get it for free. This is the most important factor, and it's where you start every single time. Before you look at tokens, charts, hype, or what influencers are saying, you ask one critical question. Is this project solving a real, painful, financially valuable problem? The best crypto projects solve problems in payments, scalability, privacy, identity, cross-chain interoperability, institutional adoption, or tokenization of real-world assets. Let me give you examples of strong problem-market fit. Chainlink solved the Oracle problem, connecting smart contracts to real-world data. Without Chainlink, DeFi couldn't access price feeds, weather data, or any external information. Polygon solved Ethereum's congestion and $50 gas fees by offering a Layer 2 solution with near-instant transactions for pennies. Filecoin and Arweave solved decentralized storage, giving alternatives to centralized providers like AWS. Uniswap solved decentralized liquidity, allowing anyone to swap tokens without a centralized exchange. These projects attacked specific expensive problems and provided clear solutions. Now, let me show you weak problem market fit examples. Meme coins with zero utility beyond speculation. Tokens with AI, metaverse, or GameFi slapped in the name without any actual substance or working product. Copy-paste forks of existing projects with no innovation. Projects that claim they'll revolutionize everything but have no clear niche or focus. Here are the red flags. Vague statements like, "We will disrupt all industries" without specifics, following trends without genuine innovation, promising to build the product after raising funding, and no clear pain point being addressed. If the project doesn't tackle a painful financial, technological, or adoption problem that people will pay to solve, it will never become a 100x. Ever. Problem market fit is the foundation. Everything else builds on this. Now we dive into the technical side. You need to ask, is the technology actually innovative or just a cheap fork of something else? Does the code base show consistent active development? Is the architecture scalable for mass adoption? Does it solve the problem better than existing competitors? Here's what you look at. GitHub activity. Are there regular commits, multiple contributors, and ongoing development? Check the repositories. White paper quality. Is it clear, detailed, and technically sound, or is it vague marketing fluff? Team technical competence. Do the engineers have real blockchain experience and credentials? Partnerships with actual builders, not just marketing partnerships with random companies. Let me give you examples. Solana introduced proof of history, a completely novel consensus mechanism that enabled 65,000 transactions per second. Avalanche introduced subnets, allowing customizable blockchains with their own rules. Cosmos introduced modularity and the inter-blockchain communication protocol for app chains. These weren't minor improvements. These were architectural innovations that changed what was possible. Technological depth is what separates a 10x from a 100x. Here are the green flags. Strong documentation that developers can actually use. Transparent roadmap with realistic milestones. Real-world testing on testnets with actual usage. Developer ecosystem incentives like grants and hackathons. And here are the red flags. No GitHub activity or private repositories with no transparency. Vague buzzwords like AI-powered blockchain with quantum security, but no technical details. White papers full of marketing language with zero technical depth, no original innovation, just copying existing projects. Real innovation takes years. 100x projects usually build quietly for a long time before they explode into mainstream awareness. If a project launched last month and promises to change everything, it's probably garbage. This is the silent killer of most projects. You can have amazing technology, a great team, and strong adoption, but if tokenomics are broken, the token will never reach 100 times. Here's what you need to analyze. What is the total supply? Is it fixed or infinite? What's the inflation schedule? How many new tokens are being created and when? What's the unlocking schedule for team and investor tokens? Are there massive dumps coming? Who owns how much? If insiders own 70%, that's a red flag. Is the token actually useful in the ecosystem, or is it just speculative? Strong tokenomics traits include low inflation or deflationary mechanisms, long vesting periods so insiders can't dump immediately, real utility like paying for gas, staking rewards, governance rights or protocol fees, and mechanisms like buybacks or burns that reduce supply over time. Examples of great tokenomics. BNB has quarterly token burns, reducing supply permanently. ETH implemented EIP 1559, burning a portion of every transaction fee. Link is used heavily for Oracle payments across hundreds of protocols. These tokens have real demand drivers beyond speculation. Now let me show you bad tokenomics examples. Huge token unlocks for VCs, and the team within months of launch, causing inevitable sell pressure. Infinite or extremely high supply with no burn mechanism, no real utility, the token does nothing in the ecosystem. Reward tokens printed out of thin air to pay unsustainable staking yields. If tokenomics are bad, even the best project can't reach 100x because selling pressure will always outpace demand. Always analyze the token supply dynamics before investing a single dollar. Before money follows a project, talent does. The quality of the team often predicts the outcome. Here are the questions you ask. Are the founders public and credible with real identities? Do they have genuine industry experience in blockchain, software engineering, or relevant fields? Are there notable advisors or backers with skin in the game? Are any major venture capital firms invested? Have the founders successfully shipped projects before, or is this their first attempt? Green flags include experienced engineers with proven track records, public founders who show their faces and reputations, backing from top-tier firms like Andreessen Horowitz, Paradigm, Sequoia, Polychain, Multicoin Capital, or Coinbase Ventures, transparent communication with regular updates, and previous successful exits or projects. Red flags include anonymous founders with zero reputation, fake LinkedIn profiles with AI-generated photos, no previous successful projects or industry experience, sketchy influencers as the main promoters, team members disappearing or changing frequently. A great team doesn't guarantee 100 times returns, but a bad team guarantees zero. History proves this. Every major rug pull, every failed project, every exit scam had anonymous or inexperienced teams. Don't skip this research. Go to LinkedIn, check their GitHub profiles, Google their names, verify their claims. If you can't find real information, walk away. Crypto projects are driven by communities and network effects. You need to verify real adoption and organic growth. Here's what you check: number of active users and wallets, not just registered accounts, transaction volume, and total value locked in the protocol. Developer activity: how many developers are building on the platform? Social sentiment: is the community genuinely excited or just bots and paid shills? Community engagement quality: are real people discussing use cases, or is it just Moon and Lambo spam? Examples of projects with great communities: Polkadot has thousands of developers building parachains. Solana has a massive developer ecosystem with hackathons and real dApps. Chainlink has integrations across hundreds of protocols. Cardano has one of the most loyal communities in crypto. These communities create network effects that drive adoption. Weak communities look like this: meme tokens where nobody talks about utility, Discord servers full of bots posting copy-paste messages, projects where only admins and moderators talk, fake engagement with purchased followers and likes. Traction proves demand, and demand drives price. If nobody is using the product, the token won't succeed no matter how good the technology is. Always verify on-chain metrics, not marketing claims. This is the secret multiplier that most people ignore. Narratives drive capital flows in crypto. A strong narrative can multiply a token's potential even if the technology isn't perfect yet. Here's why. Investors follow stories. Money flows into sectors that feel inevitable. Right now, these are the most powerful narratives in crypto for 2026 and beyond. Artificial intelligence and crypto convergence for decentralized intelligence. Real-world assets, tokenizing real estate, bonds, and commodities. Layer 2, scaling solutions as Ethereum remains expensive. Interoperability and cross-chain communication. Liquid staking and restaking protocols. Decentralized data storage and compute networks. Modular blockchains that separate consensus, execution, and data availability. 100x tokens usually sit at the intersection of a powerful narrative, real utility solving actual problems, and strong fundamental metrics. Think of narrative as fuel and fundamentals as the engine. You need both. A project with amazing tech but no narrative will grow slowly. A project with a strong narrative but no fundamentals will pump and dump. But a project with both? That's where 100x happens. When you're evaluating projects, ask yourself, does this fit into a major trend that institutions and retail will pour money into? If yes, and the fundamentals check out, you might have a winner. You can have the best research in the world, but if your timing is wrong, your results will be mediocre. 100 times returns come from early entry, not chasing pumps. Here are ideal entry points: pre-mainnet or testnet phase when the project is still building, before major exchange listings when liquidity is still low, during market-wide fear when everything is down but fundamentals haven't changed, after significant dips but before major catalysts like partnerships or launches. These are when smart money accumulates. Bad entry points include the top of a bull market when euphoria is everywhere, after huge pumps when the project is all over social media, when influencers start aggressively promoting it, which usually signals the top. Remember, 100x projects are found early, not during hype. By the time a project is trending on Twitter and YouTubers are making videos about it, you're already late. The biggest gains come from finding quality projects in obscurity, doing deep research, accumulating a position, and waiting patiently for the market to discover what you already knew. A project with amazing tech but no narrative will grow slowly. A project with a strong narrative but no fundamentals will pump and dump. But a project with both? That's where 100x happens. When you're evaluating projects, ask yourself, does this fit into a major trend that institutions and retail will pour money into? If yes, and the fundamentals check out, you might have a winner. Now let me give you the complete 100x checklist. This is a 15-point framework you can screenshot and use for every project. Number 1, solves a real high-value problem. Number 2, innovative technology and architecture, not a fork. Number 3, strong GitHub activity and consistent development. Number 4, clear, realistic roadmap with achievable milestones. Number 5, strong tokenomics with real utility, not just speculation. Number 6, low inflation and fair vesting schedules. Number 7, transparent, experienced team with public identities. Number 8, strong venture capital backing from reputable firms. Number 9, real partnerships, not paid endorsements. Number 10, growing community with genuine engagement. Number 11, actual usage metrics like TVL, transactions per second, and active wallets. Number 12, strong narrative fit with current market trends. Number 13, competitive advantage over similar projects. Number 14, early stage but with a functional product or testnet. Number 15, great risk-to-reward profile with asymmetric upside. If a token checks 12 to 15 boxes, it has potential for 50x to 100x returns. If it checks 8 to 11 boxes, it's a potential mid-tier performer. If it checks fewer than 7 boxes, skip it completely. This checklist alone filters out 95% of bad projects and scams. Use it religiously. So there you have it, a complete practical framework for spotting the next 100x crypto project with logic, research, and structured analysis, not luck or hope. This is how professional investors operate. They don't guess. They systematically evaluate opportunities and only invest when multiple factors align. If you use this framework consistently, you'll avoid most scams, skip most mediocre projects, and dramatically increase your odds of finding real winners. Tomorrow we continue with day 5 of our series where we dive into DeFi, decentralized finance opportunities and risks in 2026. Make sure you subscribe, hit that notification bell, drop a comment telling me which layer of this framework you found most valuable, and I'll see you in the next one. Stay sharp, stay disciplined, and remember, in crypto, research is your only edge.